Welcome to Taking Stock for the week ending 6th of February 2026, where myself, Tim Lincoln, and our head of stock doctor research, Kien Trinh, stream you all things share market. Well, the market's certainly been volatile, and we'll get into that in just a moment, Kien. But before we get started, just a reminder that all of the information we share is of a general nature, shouldn't be construed as personal advice, and all the data and performance metrics that we also share, all historical in nature, and shouldn't be relied upon as a guide for future performance. Well, Kien, it certainly has been extremely volatile, mainly on the back of the Reserve Bank delivering its first interest rate increase in more than 2 years. And that has led to massive swings in commodity prices, especially gold and copper. And we've also seen renewed selling pressure, massive selling pressure actually, on all parts of the software and technology sector, especially those under threat from AI taking over their businesses, which we see as completely overcooked. A lot of our businesses that are in the technology space, whether it be Pro Medicus, Technology One, and the like, they've been grossly oversold because we believe they're the type of businesses that will continue to innovate and embrace AI to improve their businesses going forward. So we're seeing that as a great opportunity. But it certainly has been wild, Kien.
Yeah, wild is the word, Tim, especially with all that volatility. But again, you spoke about interest rates. They're firmly back on the agenda. The RBA has been clear that inflation is likely to stay above their target for some time, which raises the risk that there's further rate rises, potentially as early as May. At the same time, we're seeing that rotation away from those crowded AI trades, Tim, out of those speculative and leveraged commodity positions. Even assets like Bitcoin are now back below where they were a year ago.
Yeah, everything's a little bit all over the place at the moment, Kien, and that's exactly why fundamentals matter. Speculation and momentum trades can only last for so long. We're now at the start of the first half of 2026 reporting season, which is exciting. And regardless of what's happening with interest rates, commodities, or global politics, company results will ultimately drive share prices over the long term. For investors, it's important to focus on the quality of the businesses that you own. Those with strong profits, strong return on equity, and return on invested capital, depending on the models that we select based on the company's core business, solid balance sheets with manageable debt levels, and sustainable cash flow for income investors really, really important. Meanwhile, significant volatility across these high-quality stocks that we're seeing right now should be viewed as opportunity. And Kien, right now in the Lincoln Australian Growth Fund, which is where I have most of my investments in the share market, we did a full rebalance during the week whereby we sold all of the profits or took all of the profits off the table that we had in those gold stocks that had done so well for a long period of time, and all of those technology stocks that we have a fair few of those star growth technology stocks in the Lincoln Australian Growth Fund that were underweight because of the sell down in their share prices over the last week or so. We've now loaded up on those businesses, brought the portfolio back to equal weight. So that means that we're embracing the opportunity. So these opportunities don't come along very often. And when they do, we must embrace them because history suggests that this is often a once in a generational type opportunity in high quality growth orientated businesses. So let's turn our attention now to reporting season and some of the highlights that are coming through at the moment, Kien, starting with star growth stock and sleep apnea device maker ResMed. This was a strong result and the share price reacted accordingly, Kien. What stood out for you?
Well, Tim, ResMed, they clearly bet market expectations and earnings grew strongly, margins improved, and cash generation, that remained quite robust. Importantly, their US device sales held up well, which helped ease concerns that weight loss drugs might reduce demand for sleep apnea treatment. Masks and accessories also performed strongly as well.
Yeah, and there was what an impressive result it was, and it continues to invest in marketing and R&D while still generating excessive cash. So really good positive stuff, Kien. The balance sheet has moved into a net cash position also, and this reinforces its strong financial health, which is obviously golden rule one and the foundation of all investment decisions. With the stock still trading below its highs and a large discount to fair value, ResMed could still represent an opportunity for long-term investors. Moving on to another stock now, Kien, which released its results, is X-Star stock and debt collector Credit Corp. It's more a factoring company where it buys distressed debtors ledgers from corporates, including the banks. The share price reaction was negative despite the business maintaining guidance. What's behind the weakness, Kien?
Yeah, quite a messy result, Tim. Credit Corp is a stock we're currently reviewing for potential star stock inclusion, especially if it can maintain that return on equity above that 10% under our financials model. Now, during the first half, several Australian banks, they temporarily paused selling these debt portfolios, which delayed Credit Corp's ability to deploy capital. This has pushed earnings towards the second half and is the reason why its first half result was around 10% below expectations.
Okay, and given that management has reaffirmed full year guidance, Kian, I guess the market is skeptical that this could be achieved. I'm sure, though, that your team are assessing the numbers as we speak, and of course the active risk to see whether the sell down could represent an opportunity for investors.
Yeah, that's right, Tim. And the results are coming in hard and fast now. A reminder to refer to our corporate calendar to keep track of all the announcements during reporting season. We had, for instance, REA Group today, which the listing volumes appear quite soft, but they have maintained guidance, and a few interesting names next week, including CSL, Commonwealth Bank, Breville, Computershare, and Cochlear.
And now to Under the Microscope, Kien, and let's turn our attention to online lottery platform business, Jumbo Interactive. Jumbo released their unaudited first half 26 results during the weekend. The numbers were ahead of expectations, yet the share price moved lower. Kien, what didn't the market like about the result? Because poor old Jumbo just can't take a trick at the moment. Releases a really good set of results, share price gets hammered, but it's a bit of an ongoing trend for them now for the last year or two.
Yeah, that's right, Tim. Every time share price picks up, it falls back down again. And the result, as you said, was quite solid. Underlying earnings came ahead of expectations, and that was achieved despite one of the weakest jackpot environments in several years. And the negative share price reaction was really about concerns in the Australian lotteries, where Jumbo lost some market share, and that weakness reflects the fewer large jackpots and also Jumbo's high exposure to jackpot-style games.
Yeah, interesting, Kien. But what stood out to me was that growth didn't rely solely on Australian lotteries. The offshore businesses seem to be doing quite well and starting to do a lot of the heavy lifting now.
Yeah, that's right, Tim. I mean, the key positive was the Dream Giveaways business in the UK and also in the US. They recently acquired businesses which delivered ahead of expectations and earlier than the market had assumed. Now, strategically, this matters because it continues to diversify Jumbo's earnings away from Australian jackpot cycles and towards more reoccurring scalable revenue streams. In fact, it represents about a quarter of their earnings now.
Yeah, very interesting as well. And the acquisition has certainly contributed positively to earnings revisions with them moving higher over the last 3 months. Just check out the earnings revisions under Golden Rule 3. But the dividend policy has been revised lower, which might concern income investors. How should income investors think about that, Guillaume?
Well, Tim, I mean, the payout range now has been reset to 30 to 50% to support acquisitions and also balance sheet flexibility. Even so, the forecast 3.4% fully franked yield remains above the market. And on top of that, income investors have the potential to achieve future capital gains as growth recovers in financial year 27.
So the share price weakness and large discount to fair value represents opportunity for long-term growth and income investors, even though that yield is diluted a little bit. But I noticed that short interest on the stock is trading around 5%, Cam, which is getting a little bit high for our liking. Is there something there we should be concerned about?
Yeah, that's right, Tim. I mean, 5%, it does reflect skepticism and around those jackpots and also competition. But if jackpot activity starts to normalize, and it usually does, and offshore earnings continue to surprise on the upside, that position will need to unwind.
And now to question of the week, Kien. And with the RBA lifting interest rates during the week, a timely questions from our members is, which of these areas of the market tend to perform better in a rising rate environment? Now, we're not sector specific, or we have no bias towards any sector at all, Kien, when we're selecting stocks. We just roll with it. But I know it is a question that a lot of our members have at the forefront of their mind, especially after interest rate increase.
Yeah, that's right, Tim. I mean, from a sector perspective and on the positive side, resources, they tend to perform well in a higher inflationary and higher interest rate environment. You've got higher demand, which leads to higher raw materials across the supply chain. Financials, particularly banks as well, they can perform reasonably well early in the cycle as higher rates support margins. Many insurers and platform providers like Hub and NetWealth, they also earn higher yields on their fixed interest investments or margin income. Healthcare and consumer staples also tend to hold up quite well. These businesses offer defensive earnings, stable demand, and strong pricing power, which becomes quite valuable when economic conditions tighten. But on the negative side, though, retailers and property stocks, they typically fall under pressure because of the higher borrowing costs and lower asset valuations. As we've seen in recent months as well, sentiment can also shift for high valuation growth and technology stocks because rising rates reduce the value of their future earnings.
Yeah, all very interesting, Kien, but at the end of the day, interest rate cycles are totally unpredictable, as we've seen over the last couple of years. And so just a reminder once again that the best way to manage your portfolios is from that bottom-up stock picking perspective. The quality businesses have got the ones with they have the resilience to survive and prosper in any interest rate environment. So really important that we focus on that and not become, as I said earlier, too centric towards any one sector relative to the interest rate cycle. So yeah, just invest in those high quality businesses, those financially healthy businesses with strong earnings, strong pricing power, good strong cash generation for those income stocks as well, and navigate all tighter financial conditions with confidence. Okay, Kien, great sitting down with you again. I'll let you go because you've got a lot to focus on, you and your team, now that reporting season's kicked off.
Yeah, likewise, Tim. And again, it's going to be quite busy, but we've always got time for our members. So if you have any questions, feel free to call and we'll endeavor to return your phone call within 24 hours.
Yep, great stuff. And a reminder that we grow from your referrals. So give us a call or jump onto the website if you've got a family or friend who you think could benefit from Stock Doctor, and provide them with a free trial, and we'll hold their hand and guide them through the service. Also, with our superannuation team, now part of the Prime Financial Group, we offer wonderful self-managed super fund administration. So if you're unhappy with your current provider or looking to establish a self-managed super fund, then give one of our friendly team members a call and we'll guide you through that process. So stay focused. Don't let this volatility spook you. Manage your portfolios according to your profile and the way you either embrace opportunity or use some of our other indicators to help you exit these positions if they've been triggered. Have a happy, healthy, and prosperous week.